So before we get started, I'm just going to jump into my one disclaimer is that unlike Alan, who is a financial planner, I'm not a financial planner, but I've studied the world of finance for about 30 years. And I say this only because I know people, I don't want this to be misconstrued in any way, shape, or form. What I'm sharing with you, I guess, are my experiences of what I've seen in the world. And I will, I think we all know this is probably one of the most, finances is one of the most talked about topics ever. And there are many different ways to look at and approach things. And as I get into what my background is, you'll understand where I'm coming from in a bit more detail. But what I'd like to say is this is for, I call it education and entertainment purposes. And I do work with some other organizations who have taught and mentored me, and a lot of their content, and I'll just mention one plus 12. Some of their content is embedded in this. I've stolen some, well, I haven't stolen, they've taught me some concepts that I now apply to my life and to my world. And so that's actually embedded, and I just have to get some screens adjusted here correctly. Sorry about that. Great, so I can still see everyone here. Okay, now, oh gosh, sorry guys, bear with me for one sec. I've got multiple monitors here. I'm trying to get, okay, that may not work. Anyway, so my first question to everyone is, how can I be of service to you? So I heard a few things just sort of thrown out there in the opening introductions and remarks, and just wondered if anyone had anything else that they were hoping to get out of today that they just might want to share up front before I get started.
Yeah, I'm willing to share, Andrew. I would love to know about alternative investments besides the stock market.
Okay, great. Okay, anyone else?
For me, I think not everyone is in the same position to make a big move, whether it be investing or whatever. I think I guess at the ground level, understanding kind of what you can do, what is your next step, even if just today is the next step is just to read this article or read this book or something. If there's any little steps we could make after we chat today, that would be great for people to take action on.
Perfect. Sorry for looking to the other screen here. I'm still trying to get this one screen where everyone else is. Here we go. Okay, now I can see everyone.
Andrew, I was going to ask, I've heard, different things about good credit and bad credit. So if there's any clarification to provide on that, that'd be really helpful.
Okay. I have a little bit, we'll talk about, I do talk about credit a bit in this, so let's we'll go through that, and maybe in the very end, but generally, obviously there are rating agencies, and that governs the kind of credit you have, and the thing that I always say is, continually be aware of what drives that credit rating and try and do things to optimize it as much as possible. And there's a reason why I say that, and I'll get into that in a teeny bit. How about anyone else?
I'll just chime in there. I'll add to that. I did like a little podcast actually with debt consolidation trustee not too long ago. So like I have like a 60-minute call like about that, about credit. So it might be interesting. I can share it with you guys if you're interested.
Yeah, I mean that from my perspective, absolutely.
But just as an aside, for me, for additional, just really kind of interested to see what your take on current market situation is. If you have a little bit of an outlook moving forward, or I'm always interested to see and hear people's opinions on that.
Yeah, for sure. And that's something that I'll get to a little bit further into things in terms of what I see happening right now. And really the lens that I look at this from is looking at what's going on right now from the perspective of what are repeatable patterns that always occur. So that's my perspective on that. Okay, so I think unless there's anyone else, I'll just jump into things here. Okay, so what's going on here? I do a lot of things, but one of the things, one of the things that I've done over the last little bit is I created this thing called Wealth.OK Network, and the whole concept behind that is that I have a vision that I hold for people of the world, and it doesn't matter what where you're going, what direction you're going in, because everyone on this call is going in a whole bunch of different directions. And I heard some really cool, like I was excited to hear about all the things everyone was doing, frankly. You had your own missions in life. And that's one of the things that I think is a very powerful thing to get you motivated. What I will say is that the stronger your finances are, the more flexibility you have to pursue whatever it is that you are here to do on this planet, right? And so, and I don't judge that goal. All I really appreciate are people that have a strong vision of who they want to be and what they want to do. And then from that, I have a vision that I can empower them around their finances. I show them a way where they can attain more financial freedom. I help them be in action. And that's what Brian had spoken to, like what are some of the things we can do? I've created and continue to create tools and things that will help people work towards their goals, and then I help support and educate them and what's going on in the world. And again, I look at it, so if I move forward and just give you a bit of a background on what I did, I originally was trained as an engineer, and then excuse me, there's my little thing. And then I went on to manage real estate assets for Bell Canada as my first job. It was kind of a strange thing. And from there, I really became in tune with how the real estate market works. And we had like 600 assets in Southwestern Ontario that I was managing, and did a whole bunch of cool stuff when I was in my early 20s. And I went on to then study within the corporation. I studied economic planning and how they evaluate projects and what projects they choose to move forward with, and did a whole bunch of financial analysis in that area. And then from there, I went on to do many things in management and operational management of various large companies until about 10 years ago, when I finally said, like, I'm sick of the corporate world. I want to do something different. I want to be entrepreneurial. I'm way more entrepreneurial than the environments that I've been in. And people would always tell me that, like, well, what are you doing here? Like, you're too much of a, think outside the box kind of person. So that's when I really started to went off on my own. And the first thing that I did is when I looped back to, what I was doing, I said, like, who's really going to mentor me through this, and who's going to mentor me through the financial journey of becoming an entrepreneur? And one of the things that I thought about was who has the most knowledge about these things, and it's people who manage intergenerational family wealth. So from there, I actually found some people that I work with, and I started to learn about intergenerational family wealth and how the wealthy look at the world at large. And it's a totally different perspective than what I had always looked at the world of finance and being. And that is just, the public stock markets, and I get a stock tip from a friend and who's investing in what and all that kind of thing. So that's kind of a bit of my background. So the next question I always like to get into, and what I'm trying to do is I'm jumping through like a broad amount of material at a very sort of high level, and I'll drill down in a couple of areas, and our conversation will lead us to what we need to talk about more. But I just throw it out to everyone and say to anyone who can name the financial system that we're in. So what's the name of the monopoly game that we're actually playing? So I'll open it up to you guys.
Like the imperialist system.
Sort of. There is parts
Capitalism.
of that.
Capitalism.
Yeah.
Capitalism, yeah, and parts of the world, we definitely have capitalism. Anyone else? Okay, so here's the spoiler. The actual name of our financial system is called the fractional reserve banking system. I don't know how many of you have actually heard that name or terminology, and this is, okay, a lot of nodding heads, So, and essentially, to really, I guess I'd like to dumb it down and keep it simple, but to keep it simple, what that system is that you take a bank, for example, and you have depositors in the bank and you have people who borrow things from the bank, okay? And so kind of in a very simplistic mind, one would think that if someone deposits $100 in the bank can only lend out $100. But in the fractional reserve banking system, the bank can actually lend out that $100 more and more and more, many times over. So what it creates is a multiplier effect. So, and that's how, when you think of it, like, and what that means is that there is sort of a leverage and a multiplier effect on the whole financial system. So small things that happen result in bigger and bigger results to the overall economy. And you know, our banks have to have a certain amount of money on hand at any given time, and that's called their reserve. And that's so that, you know, that's to cover the people who go there at any given day and say, hey, I want my money out today. So, so what does this mean? So in the fractional reserve banking system, as I said, because of the, what I'll call the multiplier effect, what that means is that we see what we call economic cycles, right? So we're all familiar with the concept of an economic cycle. Well, in the system that we have, economic cycles are just part of what is normal. And so there's often talk about, oh, how can we adjust that? Or the government's always trying to step in, or the Bank of Canada is trying to step in. I would say most of what they tell you about what they're trying to do is sort of messaging and positioning. And the reality is that the nature of the design of the system is that things go up to a certain point in time. And I'll talk about this a little bit later. And then you hit a certain level of market sentiment. And then that market sentiment, like the feelings of people in general, is what drives the majority of underlying things. And COVID, if there ever were an example of that, COVID's an example of that. Because if you look at really what's happening in the current markets, both the financial markets and the real estate market, in the background, our actual fundamental economics are not in great shape, yet those markets continue to go up. So, so economic cycles have always had a component of sentiment, and more so now than ever. I think we're really at a high economic sentiment thing. The other thing about fractional reserve banking is so our money used to be tied to what was called the gold standard, and most people have heard of the gold standard. And back in the 70s, we separated from the gold standard. And that meant that no longer did you have, and gold has always been viewed as being, in historic times and ancient times, real money. So when that was decoupled, what happened is, and I have tons of charts which I haven't put in, but essentially, as credit in our economy goes up, economic growth occurs. And so in Canada, there's a bit of a spread, but once we have 7% credit growth in every year, we generally have positive GDP. In the US, the numbers are a little bit different and lower. And those can be tracked really historically over the last 30 and 40 years. That really, it's the increase in credit that causes what we're calling economic growth. And so, we coined a term called creditism. So, and I think the fundamental thing to take away, and there's a lot of things you could take away from this, but the fundamental thing to take away from this is that credit is growth. So credit is what economic growth is. And then the final thing that I will say, and this is something that came to me over, you know, the last little bit with the election and everything, and I watched the questions that were being asked, and it's interesting because Patty, you mentioned something in the beginning about, you know, messaging in a press release that you had mentioned, that how to build back better, or building society back better and sustainably. How do we determine what's important in society? And as I watched some of the political debates that were going on over the last 6 weeks, I noticed that really questions are structured in a way that they shape what people will believe. So it's not like the question is there a problem with unaffordable housing? The question is, how do I address affordable housing? Or it's not that the question is, what's the best approach to take to greening the economy, but what is your plan for greening the economy? So there are a lot of things that shape us. And what came out of the last 4 to 6 weeks for me, and I already knew this, but it really got reinforced, is that a lot of us are just on a train where we pick up information from a single source. All the sources are essentially consolidated because in Canada and around the world, there are very few sources that own all of the media. And in Canada, all of the media is funded by the government. So would expect that what the government says and what the media says are very aligned. And what's missing is kind of the synthesis of ideas. So there's never a discussion of A plus B equals C. So it's sort of like, here's my thesis, what's my counter thesis, what's the best way to go forward. It's always like things are just shaped. So it's always like you never actually question or think about what you're being told. You're just told, and it's repeated. And I was reading an article in the New York Times over the weekend, and I was thinking, I found it very interesting because they were making all these statements, and I'm like, those aren't even things that people look at and measure. But they were writing it like it was the news, but there was no way of actually verifying what they were saying was true. So I thought to myself, it's very interesting and ironic that is now how most of us look at things and get things now. And I get it, because we all have things that we're focused on, we're prioritizing. And it's, it's a busy world and we're just trying to get our information quickly. But the thinking component and the logic of what's actually going on, and I'm also an engineer, so I've always thought logically, but I think that's just getting diminished more and more and more to the detriment of our society. So, and this is that was macro. This is back to kind of people in our lives. So one of the things that we study is what we call the 7 destroyers of capital. So I'm just going to put them up here really quickly. And and I'll just read them off. Actually, they come up in sequence here, but taxation is the biggest destroyer of wealth. So if you look at it in Canada, for example, depending on your marginal tax rate, anyone who's earning a decent income, between 30 to 6% of your earned income, and sometimes higher, goes to taxes. It goes to consumption taxes, income tax, property tax. Canada is probably one of the most highest taxed regimes in the world. I think we have over 800 identifiable taxes and tax programs. Income tax was actually put in place to fund, I think, the First World War. And what happens, it seems, in Canada is when we implement a taxation policy, we never remove it. The next thing is inflation. So, and we're all pretty familiar with that. But what that really means is that, what you could buy for $100 today will, depending on the inflation rate, but in a year, if it's a 5% inflation rate, it'll take $105 to buy that same thing the next year. This one is one that I'll talk about further, but lack of sound financial practices. We sometimes call that stupidity. And I don't mean that, I don't mean that in a derogatory way, because I have engaged in stupid practices financially over the course of my life. I have made mistakes. I've done things that after I did them, I said, okay, well, I'm never going to do that again. We all have. I mean, that's part of the journey we're on. It's unavoidable. And that happens in every aspect of our life. So it's hard to, it's hard not to assume that it would also not happen in the realm of finances. Untimely death and, Alan sells insurance. I mean, there's different ways to mitigate for that, but family's finances can be stopped suddenly if the key breadwinner dies. Disability is the same thing, and to the extent that it limits your income. And then if you're, the double whammy of that one is if you're living and you have a disability, you have suddenly costs associated with dealing with that. Divorce, we've heard split it down the middle, 50%, that erodes family wealth. And then litigation is another one. So and people, particularly small business owners, one thing to always look for here is that when you're out there doing things, depending on how closely coupled your business is to your personal life, if something happens in your business, that cross component of litigation or someone coming after you or you being responsible if you're not incorporated, that can expose your wealth. So anyway, the question is always thinking about which ones you're potentially exposed to. So then, as I sort of had alluded to earlier, when I was thinking about this whole realm and when I really started to change and shift the direction I was going in, I said, what are the characteristics of successful financial people and who are they? And so, as I said, there's a lot of things that are going on in the world. And it's a real important question of who do you listen to? So I came up with my criteria. My criteria was I'm going to listen to people who have experience in doing this multi-generationally and or I've studied people who are doing that. So it was about taking a real long-term perspective on what's going on. And what I found when I started doing that is that there were 4 characteristics that they had. And what those people had was that they had a strong vision of what they wanted to do and accomplish, what I refer to as a state of being. It's like almost like that is who they are. And then only then from there would they start to strategies and get into thinking. And then from there, they built routines, which are planning. And then from there, they actually built a measurement system, which is what I call acting. So, for example, if you have a goal that you're going to add a certain amount to your savings over the course of a year, you would have your vision, you would have your strategy, then your routines would be how am I doing that every day, and then my actual measurement or acting is actually checking to see that I'm doing that and making sure I'm doing that. The other thing that these people had is they had investment policies. So as I said earlier, we, often I've made mistakes in the past and I've done things that if I had actually had this very simple investment policy, which is a common one, which is 3 things, which is just security of capital, security of returns, and security of the exit strategy. If I had that policy in place, then I probably wouldn't have made the mistakes that I made in the past. So the question is, what are your investment policies? So, okay, and then I'm going to throw in, this is my what I call my quick hacks. So Brian had always said, what are some actionable things that you can do? And these are some things that I use and are part of the programs that I do, and they just measure your kind of overall level of financial health. So, and anyone can do these 3 quick things. And in fact, if you want help calculating numbers or anything, definitely reach out to me. But so, can you afford your home? And that's just your housing expenses divided by your income. And that's, we find a comfortable range, although in the GTA, people are pushing over that. It's less than 30%. How wealthy are you? And this is just one of the simplest calculations and I remember I went over this with Brian and he was like, wow, that's pretty simple. But if you take all of the assets that you have and you divide them by your monthly expenses, it'll give you the number of months that you are wealthy. So, and you can look to that to say like, that's what my reserve is, or that's how long that's how long my wealth will carry me for. And obviously the goal there is to keep increasing that. And then finally, do you work for your money or does your money work for you? So one of the things that I talk about, and I think that is important for everyone, is that there's 2 realms where we can actually make a difference. And that's in our passive income and our earned income. And so earned income is typically what we get from our business and our job and whatever. And we use one of the strategies that a lot of people use is how do you take that earned income and then start generating passive income from it? And that passive income becomes, more and more reliable. And then once you hit 50%, your money is actually working for you. So it gives you a degree of flexibility. Some people call that a conditioned state, where they call it retirement, where they change their conditioned state. And retirement doesn't, to me, mean you stop working or you stop doing what your passions are. It just means that you have another level of financial security. And I'll just pause for a second there, because I know I'm just jumping around and going pretty quick, but just any questions from anybody at this point in time? Okay. Cool. So the current economic environment. So I don't know that there's ever been a point in time when there are more things going on at a broad level, and it's hard to really, pull them all together. So we have geopolitical uncertainty, and that relates to sort of the US, what they're doing, versus China, what it's doing, versus Russia, what are they going to do? You have the old order, which is sort of the imperialistic model, which is the United States, and they maintain their stature in the world with an army, frankly, which is what I call the old school imperialistic model. Will that be changing? Will they be decreasing the size of that? Afghanistan pullout, where you had, essentially you had 20 years of the US's involvement in Afghanistan revert back to where it was beforehand. What does that mean? Is there going to be an increase in terror? Are the Taliban or some other emerging terror organization going to start attacking the US again, or attacking other Western countries, which for a while had sort of gone into, a bit of a recession? Then there's COVID, and for 2 years we've been living in this sort of strange world where, like, we think we know what's happening, but do we really know what's happening? What's going to happen next still seems to be tied into that. We have the concept of basic human rights are being looked at, and whether and I don't judge any of these things, whether they're good or whether they're bad. There are things that people are saying, like, suddenly we've gone into this mindset where you have to do this for the better of me, and we're going to force you to do it. And that fundamentally goes against the principle that we've actually espoused in our Western democracies. Economic recovery, like, are we in a recovery? What's happening with recovery? Are we gaining jobs? Are we losing jobs? There's a lot of talk of hyperinflation, hyperinflation, and people have looked to, in that fractional reserve system, we have this thing called the Bank of Canada. The Bank of Canada printed a lot of money last year, and as well as the US Fed, which is continuing to, and they're both continuing to print money. Is that going to result in inflation or hyperinflation? We're seeing the precious metals sector, and what I mean by that is there's renewed interest in precious metals. So precious metals are sometimes called real currency. So the real currency. So we're seeing the price of gold, although it's had some volatility, it's increased obviously at the beginning of COVID, and it tends to be in a relatively strong position. And then the question is the US dollar versus other dollars around the world. But in the midst of all of what I'll call all these, and many of these factors have created a lot of uncertainty. As I said earlier, everything's going up. And most, I'll say this as a general level, because the real estate markets and the stock markets are all really consist of portfolios that are comprised of assets that have what I call high sediment value, and they're devoid of assets where there's low sediment. So again, people's feelings are what's driving the market. And this is what I say. And what I say here is that this is where the risk is. So things to consider. So the Fed earned $86 billion in 2020. And that's, and Apple, the largest company in the world, the largest corporation in the world, earned $57 billion during the same time. And the Fed's, it's an interesting kind of thing. It's a private business. And so how the Fed did that is they basically lent money out for more than it cost them to borrow that money. So the Fed is in a very interesting situation, but I put this up there because the Fed is used is doing what I call, they're using constructive debt. So they are borrowing money to make money. And there was a question earlier about debt, and the biggest single thing that everyone could take away, if there's one thing that you really take away from this call or this meeting, is that there are two types of debt. There is a type of debt where you're earning money from that debt, and there's a type of debt that you're not earning money from. So when you go out and buy, shoes, and I'm not saying there's anything wrong with shoes, 100 pairs of shoes on your credit card, and you're paying 20% earning or 20% interest on that debt, that's destructive debt. Like, that's debt where it's used for consumption, the consumption is over with, and now what you're doing is you're just extending the period with which it's taking for you to pay back on that consumption. So in an ideal world, none of us would have any destructive debt, but the reality is we do. And not every, like, there's not a single person out there that hasn't had some level of destructive debt at some point in time. And it's not necessarily a bad thing. It's not the worst thing. The thing is, there's also something called constructive debt. And if you can borrow money and you can earn more on that money that you've borrowed, that is constructive debt. And that is why I brought up the concept of creditism in the beginning of this, because that is really what has been driving the majority of our economic activity. So in a way, if you can also use leverage that you have available to you, that is how you can drive up your own family's economic activity. That is one way, and that is the way that many people that I work with do it. Okay. And then the other thing that I think is really, really critical to what's going on right now is that, as I said in the last slide, there's a lot of risk cooked into a lot of major, a lot of things that are going on right now. And when that sentiment changes, and it always does eventually change, and economic cycles have been the hallmark of our fractional reserve banking system and what we will call capitalism, for lack of a better term, having cash reserves and having cash available to you to take advantage of what's going to happen in that downturn is kind of is king. And so they've heard the saying, cash is king, during the, and also make hay when the sun's shining. So this is that opportunity. Like right now, until this thing ends, until the ride ends, everything you can do to have cash and build up your cash reserves, earn as much as you can through your business, do whatever you can right now to work as hard as you can. To me, that's the biggest single thing you can be doing as business owners, as individuals, as people who are trying to steward and grow your wealth. Do that right now, because there will be a time where that's going to shift. And we'll get into, maybe we'll talk about it in the end when we see that happening. But that time is coming. And then the thing is, there are strategies for certain cycles that we're in. And we're in one phase of the cycle, and the strategy in that one phase of the cycle is just continue to build your cash as much as possible. And then one other thing that I've also been watching, and I find it quite fascinating, is with what I'll say a polarization to some extent of politics, particularly in the US, but it's also happening elsewhere. Is we're seeing what I don't want to call them economic refugees, political and economic refugees, but we're seeing people who have the means to move to jurisdictions where they can more optimize their economic growth and their fundamentals. And this is also like, if one thing, there was one thing we learned in COVID, it's really, how do you, like we can, a lot of us can have work from anywhere with what we're doing right now, right? So typically in the past, I would have come out to you and we would have had a face-to-face meeting and it would have been great. Now we're doing it on Zoom. And as that happens, more and more people are realizing like, hey, wow, like I live here. So why do I live here? And I'll just give you a little example. So, and then this is not necessarily a new trend, but in the US over the last 10 years, about the population of the state of Illinois, where the great city of Chicago is, has been decreasing. And the majority of those people have been moving to Florida. Now, they're doing that because for a number of reasons, but one of them is that the tax rate, the marginal income tax rate in Florida is lower than it is in Illinois. And what's interesting is the demographics of these people that are moving. So the mean income of people who are moving is $117,000, as opposed to the mean income of the people. And thanks for the clapping. I'm not sure, Kathy, you're so funny. I keep seeing you in the background, smiling and laughing, and I'm like, wow, my smile feels like it only goes like so high before my sinuses get filled up. But anyway, so the mean income of the people who are staying is about $40,000 a year less than the ones who are moving. And that's just one situation. We're also seeing people who are looking to move to other countries geographically around the world, because they find that they're either more aligned with what's going on in those countries, or there's more favorable economics. One thing that I can observe, and I have been observing, as I hit on in Canada earlier, we have the highest number of taxes of any jurisdiction in the world. And what we just voted for yesterday was, frankly, to increase those taxes. Like, I hate to tell, like, it's no surprise to anyone. Like, the regimes that were given more power, I guess, or reinforced in power, are the ones who are saying they want to tax people more. So it is something worthy of consideration. Like, how do you want to structure yourself in that this place where we physically live right now, the level of taxation, I guarantee, is going to go up. There's no other way of putting it. So taxes are really being the number one destroyer of wealth. Taxes are going to increase, which means that more of the money that you earn is going to go to some other thing. And listen, we'll hear a million and one things, and I'm speaking off the cuff right now. So, but we'll have a million and one things. It'll be, we had to do it because of COVID. All of these things will be, and they'll be pointing fingers and this, that, and the other thing. One of the things that I will say is there is very little control over where a lot of this money that got printed over the last year and continues to get printed has gone. So again, I don't judge any of this. I look at this as an observation of what's going on, and then how can that impact us as people living in this system? And is there something to do about it? Yeah, there are things that you can do about it. So the final slide that I have before we open it up to discussion and questions really is just this concept of asset cycle investing. So it's pretty obvious what asset cycles, as I mentioned earlier, are really hitting a peak. And so the question is, what asset cycles may not be in a peak right now, or may be on the way up? And so the ones that we know that are on the way up is technology, and we see that it's like another thing that's just obviously clearly been talked about through all of COVID is technology, and how that's going to play a bigger part in our life. And there's a whole spectrum of things that are going on there, and that always has good baseline potential. Alternative currencies, cryptocurrency. One of the reasons why I put it up there is this whole thing called blockchain, and you don't have to understand what this means, but the power of blockchain and smart contracts means that the potential for cryptocurrencies, electronic currencies, and blockchain enabled things as far as business, as far as global business goes, and as far as those what I'll call financial and economic refugees goes, still has a tremendous amount of exponential growth potential. And I've heard many people go like, is it too late to get into crypto? Is crypto over? And the way we look at it, and we have a lot of off the cuff discussions, is that there's just so much more growth potential in it that you will never go wrong in the long term. And listen, let's call a spade right now. The majority of these crypto itself is being used in a speculative way. It's a speculative investment, and it's kind of a little bit of taken away from the traditional what I would say insurance investments, which are gold and silver, precious metals. But that's going to evolve, because more and more and more the uses of crypto are becoming apparent. And I think it's correct, it's Guatemala just recently actually said that they recognize crypto, sorry, not crypto, brain fart guys, you know which one I'm talking about, the major cryptocurrency.
Bitcoin.
Bitcoin, thank you. Appreciate the help from the peanut gallery. So Bitcoin can be used as official tender. So you can pay your taxes and pay other things with it. And, so there are a lot of people, economically well-to-do people who actually also hold a lot of cryptocurrency, and they're now looking for, so this is a kind of a minor revolution occurring in the background. They're looking for jurisdictions where they can go to, where they can actually do what used to be the old imperial model, but in a different way, where they can create the kind of communities and lifestyles that they want to see. And so they're sort of voting, it's kind of like in a weird way, it's making what we call geopolitics somewhat obsolete, in that they're just taking their knowledge and their expertise and they're building what they want to build, like what their vision is of whatever that is in their own communities. And crypto will be one of those things that enables that, because it's obviously universally recognized. And listen, everyone's trying to get, all the governments around the world, they're also going to try and get their fingers in that game. And their game is always, how can we tax you, right? So they're looking to participate from that perspective. And then artificial intelligence goes without saying, there's going to be a massive level of expansive growth in here, and we're just scratching the surface of opportunities. And that the question is, at what level does that make redundant, humans redundant? And what I will say about artificial intelligence, and one thing to just bear in mind, is that there are certain things that our brain is good at, and there are certain things that our brain is not good at. Processing massive amounts of information and looking for patterns our brain does not do that very well, right? Has anyone found that they're great at that? Any show of hands? No. So I see no hands that say that processing large amounts of information, that is one of the things that artificial intelligence is good at, to see patterns in that. What our brains are really good at is creating ideas and finding creative solutions to solving problems. And I see some nods on that one, that you guys agree with me. And we're all entrepreneurs, and we all know that everything that we've done from the day we put that label on ourselves as we became creative geniuses, we just started creating things, and then we just we went with it, right? So what I seeing here is that a lot of the stuff that consumes our brain processing can be done through artificial intelligence, and we can use those outputs to then figure out what the next creative solution is. So I don't look at that as a threat. I look at that as a way of really, how can we become say, how do we live a more fulfilling life? How do we do that? Finally, the green economy, and we've heard about it. All I will say is that this is just my opinion, that all of the things that we talk about in terms of sustainability and all these things, what the messaging is great. There are a lot of actions that contradict what that messaging is. So I don't know that governments are devotedly aligned with what we'll call the green economy, because they've done some pretty crazy things. But on the other hand, there is the whole thing behind the reason I call it the green economy is there is a whole bunch of people who are doing things that are green, your group being one of them. And those things are going to continue to be bigger components of the economy going forward. And I would say that, like crypto, we are still in the relatively early stages of all of those things happening. So when the next, as we go through the next cycle, what we can expect to see is that these things continue to have movement into them, and people continue to expand and build those things. So that's why. And then finally, travel. The catch-22, the $1 million question is, will we ever return to pre-COVID travel levels around the world? I don't know, like that's a tough one to answer, but will we get to 50 or 60% of that, or some maybe even higher number? I think we will. And one thing is that if there are assets in this world right now that are in the travel sector that are extremely low value because that industry has been devastated. Those people are just holding on in some cases. So we're like myself and my partners, just as full disclosure, we're involved in purchasing of assets in that sector, and particularly in the hotel sector, where those assets have been like they've been going down in value. And again, like we have and I had this good curve, but it's kind of like, and I'll try and do it, but you have cycles and waves of things that if you look at the stock and real estate market, we're kind of at this tipping point where it's going down, but there are other things which are the ones that I'm talking about, which are extending into time, are either at a trough and are starting to come up, or are just starting to come up on the upswing. And so one of the things to think about is at this stage, how do I take advantage of my overpriced assets in a scenario where those assets are probably at the top of their cycle, if not at the top of their cycle, and move them into these other categories where the assets are maybe at the bottom of the cycle and the opportunities are starting to open up. So, wow, that was quick. Discussion and takeaways and actions that you can take. So why don't we just open it up for questions for now, and then we can start talking about, I've already mentioned some things that I see as things that you can take, but why don't we open it up to questions for now?